the taxation of capital assets. So we talked about in the last chapter capital assets. A review, all assets are capital except ordinary assets, ordinary income assets, which is accounts receivable, creative works in the hands of the creator, and inventory. And then the second is section 1231. These are depreciable or real or personal property held in use for trade or business for the production of income held long term. So a sale or exchange requirement. So if it's a sale, a casualty or theft, or corporate bankruptcy, which is a worthless security. We're going to talk about all of that. We're going to talk about when a realized gain must be recognized unless Congress defers or excludes that income. So 1031s. After conducting a thorough investment portfolio analysis, Eric decides that MNL Inc. stock no longer fits his asset allocation and sells shares on the open market. The sales constituent constitutes a realization event. So your portfolio income, portfolio overall will go up and down with the market, but it's not realized income until you actually sell the stock. It's unrealized gains until that happens. Eric will calculate the gain or loss, and absent any IRC provision deferring or exempting any income, will be required to recognize the gain on his individual tax return. Recognition in the event of a worthless security. We briefly talked about this in another chapter, but on December 28th last year, Jamie purchased 1,000 shares of Jafra Industries Inc. The company declared bankruptcy on January 5th of the current year, and the security became worthless. For federal tax purposes, the security technically became worthless as a constructive sale on any worthless security December 31st in the year that it became worthless. So it became worthless in January, but we're going to say December 31. Calculating the gain or loss. So we did this. So amount realized minus the adjusted basis equals our realized gain or loss. Just covered this in the last chapter. How do we get adjusted basis? Well, the cost of the property plus any capital additions minus any recovery, which is depreciation, equals adjusted basis. Belle purchased a Ferrari 10 years ago for $80,000. She used the car for personal use and then sold it this year. Because the model she purchased was a limited edition, she was able to sell the car for $90,000, even though she used it for 10 years. Belle's gain calculation is as follows. So because it was a personal asset and not used in the trade or business, there was no depreciation. So you take the sale amount realized, $90,000, less adjusted basis equals gain. The realized gain of $10,000 must be recognized under income return this year. Disallowed losses. Losses on the sale or conversion of personal assets, losses on the gift or sale of personal property to a related party, and wash sales. Anastasia purchased her personal residence 16 months ago for $290,000. She lives in the city and has been heavily affected by a current recession. She needs to sell her home due to relocation for a lucrative job offer. Good for her, right? So the best offer she receives was $265,000. She sells her home and suffers an economic loss of $25,000. So currently, as the tax law stands, losses on the sale of your personal residence are not deductible. Ursula purchased Titran stock 3 years ago for $30 a share. It's currently valued at $25 a share. She decides to give her son shares of Triton to Sebastian. Sebastian immediately sells for $26. The $5 loss incurred during the holding period will never be recognized because it's a disallowed loss due to double basis rules. Sebastian has an economic gain of $1 per share because when he was gifted it, you have to take the fair market value if it was lower than basis. And because he sold in between the double basis, the fair market value of the purchase price or the adjusted basis, then there is no gain, but no loss either. Wash rules apply when the taxpayer sells a security for a loss and purchases a substantially similar security within 30 days, before or after the sale. The tax consequences are the loss is not recognized and is added to the adjustment basis of the replacement property. An example. Percy reviews his portfolio and decides to sell 100 shares of Bear stock November 1st for $20,000 to offset some of his annual gains. He purchased the stock 2 years ago for $30,000. So we got long-term and a loss of 10,000. Percy subsequently reads in an investor report that Bear stock was a new patent and for a potentially high revenue product. On November 20th, Percy purchases 100 shares of stock for $15,000. He's not able to recognize the $10,000 loss due to the original loss on the original sale due to wash sale, which is a sale or purchase within 30 days. So what will happen? We'll take the $15,000 he bought the new stock for, plus the $10,000 loss on the original stock, and now his new basis, instead of being 15, is 25, but no loss. If you're holding a capital asset greater than a year, then it's a long-term capital gain and loss. If you're holding it less than a year, it's a short-term capital gain and loss. Gill purchases 100 shares of Reef Novelties Inc. stock on March 17th for $10,000. On the 18th, the following year, so a year and a day, he sold the stock for $12,000. This is a $2,000 gain, so amount realized minus adjusted basis, and he will be treated as long-term since Gill held the stock for more than a year. Special holding rules. It's deemed long-term if it's deemed to have a long-term holding period if death is considered long-term. So if you inherited the property. On gifts, if fair market value is greater than the basis on the date of gift, then the holding period of the donor goes to the donee, the person receiving the gift. On a gift, if fair market value is less than the basis on the gift date, then gain basis used on sale, then holding period. So if you sell it for a gain but it was less than the basis, then you use long term. If you sell it for a loss, then the holding period starts on the date of the gift, giving you a short-term capital loss, which is more advantageous than a long-term. Related party sale transactions, holding period begins on the date of the sale. Non-business bad debt is always considered short-term. And non-taxable exchanges, holding period of the replacement assets includes holding period of the original asset. So we talked about this previously, but the long-term capital gains rates are lower, so that's why it's advantageous to have a long-term. And if you're in Massachusetts, the short-term Massachusetts capital gains tax is 12%. So instead of 5%, so you definitely don't want that. So the capital gains rates for the federal government are 0, 15, 20, 25 for recapture, and 28 for collectibles. The net long-term losses are limited to $3,000 maximum against other income per year, carried over indefinitely. The effect of the rate may be more than the maximum long-term capital gains rate. Capital gains increases the taxpayer's AGI. It may lead to phase-out. So if you sell stock, you might be phased out of certain credits. So you want to take that into account. And you also may be subject to NIT, net investment income tax. NIT, which I said on the other example I used for Chapter 10, applies to the lesser of net investment or modified AGI over the threshold not indexed of $250,000. Net investment income includes portfolio income, income from passive activities, gains on disposition of property, but does not include distributions from qualified plans and IRAs. Capital gains for those above the threshold may be taxed at 18.8, which is the 15% plus 3.8% net investment tax, or 23.8 instead of 15 and 20. Capital gains and losses must be separated from other types of gains and losses for two reasons. Long-term capital gains may be taxed at a lower rate than ordinary, and net capital losses are only deductible at $3,000 per year against ordinary income. Determining the capital gain or loss. For non-corporate taxpayers, capital gains and losses must be netted by holding period. First, short-term gains and losses are netted. Second, long-term gains and losses are netted. And if possible, you net long-term gains and losses are then netted with short-term gains or losses. If the result ends up in a net capital loss, the deduction is limited to a max of $3,000 per year. Undue losses retain their character as to short-term or long-term and are carried forward indefinitely. So an example, you have $15,000 in short-term capital gains. You have $10,000 in short-term capital losses. So that's a $5,000 net short-term capital gain, NSTCG. long-term capital gain of 3,000, a loss of 5,000. So that's a net long-term capital loss of 2,000. You would then put these two numbers together, resulting in a $3,000 net short-term capital gain. So this long-term is offsetting the short-term. So we only end up with 3,000 net short-term gain. Capital losses are generally offset capital gains. May not be used to deduct against other sources of income, except for up to 3,000 in capital losses can offset other income per year, and up to 50,000 of losses or 100,000 married filing joint on Section 1244 stock can offset other income, as we discussed in previous chapters. All right, that's the overview of Chapter 11.